Welcome, 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 everyone. This is Denise Appleby, as if you didn't know from my accent, right? So we're here for part two of the series that I'm doing, where the IRS explained their interpretation of the Secure Act. Today, we're going to be looking at the distribution options for eligible designated beneficiaries. And as I promised, I'm breaking this down into as big as a bite-sized piece as I can. So for this session, I am looking at eligible designated beneficiaries that are not spouse eligible designated beneficiaries, because trust me when I tell you, the rules that apply to spouse beneficiaries are very intricate. So that's what I'm going to be doing next. Now, just a reminder that we already covered the distribution options for designated beneficiaries. Now, if you do not have a link to a copy of that, please just let me know. As a matter of fact, when I send out a link to the recording for this, I'll just include everything, a link to everything. The learning objectives here today are so that we can identify who are eligible designated beneficiaries. I know you think that you know who that is, but trust me, you probably don't unless you have been doing a lot of reading, which you shouldn't be, because that's why I'm here. You send me your questions, right? We're going to be looking at the distribution options for eligible designated beneficiaries that are not spouses. And I want to spend a little time on what happens when the IRA owner dies on or after the required beginning date. What about the RMD for that year? Because some changes were made for that year of death RMD. We always want to remember the distribution options for a Roth IRA are the same as those that apply to a traditional IRA when the traditional IRA owner dies before the required beginning date. Because sometimes I get the question, well, Denise, what about Roth IRAs? Are the rules the same as those that apply to traditional IRAs? And the answer is yes, providing the traditional IRA owner died before the required beginning date. So as we go through, just remember that. The Secure Act is why we're here today. So to go back a little, that was signed into law in December of 2019 and became effective in January 1 of 2020. And the Secure Act made a lot of changes, including increasing the age at which required minimum distributions, RMDs, start. They changed the distribution options for designated beneficiaries. You remember the big blow up, oh, the stretch is dead, the stretch is dead. Well, that's what we're talking about here when we say a change in the distribution options for designated beneficiaries, because designated beneficiaries are no longer permitted to take distributions over life expectancy periods that are longer than 10 years. And they introduced eligible designated beneficiaries. Now, I hear from some of you, and I've seen it myself, where financial institutions are nice enough to offer the service of calculating RMDs for inherited accounts. And that's a welcome service for many because the calculation can get so complex. But I want to remind you of the risk of that, because when an IRA custodian sets up a beneficiary account, in my experience, they look at the date of birth on the beneficiary account, and some might ask about the date of death of the account owner. And they calculate distributions over the beneficiary's life expectancy, but that is not enough. We need to know date of birth, date of death of the IRA owner to determine if the IRA owner died before the required beginning date or not, because that drives the distribution options. We need to know the date of birth of the beneficiary. That helps us to determine if the beneficiary is an eligible designated beneficiary, including whether they are a minor. We need to know if the beneficiary is a surviving spouse of the IRA owner, because the distribution rules that apply are different. Is the beneficiary disabled or chronically ill? This is important for accounts that are inherited after 2019, because if a beneficiary is disabled or chronically ill, that beneficiary is an eligible designated beneficiary. And we also need to know, are there multiple beneficiaries of the account at the time of death? Because if you have multiple beneficiaries of an account, in some cases, the life expectancy of the oldest beneficiary is used unless there's separate accounting that occurs by December 31st of the year following the year of death. But with the proposed regulations and with Secure Act, that is not always true. And I'm telling you all of this to say, if you do have a client who, oh, before I forget, we also need to know if the beneficiary is a successor beneficiary. Because as you and I know, the successor beneficiary's date of birth is never factored into the equation, right? So make sure if the custodian is calculating the RMD, you give them all that information. That will help to ensure that the calculation is accurate. Now, as I said before, one of the things that Secure Act did was to increase the starting date for RMDs to age 72. For those who reach age 70 and a half by December 31st, 2019, the required beginning date was April 1 of the year that follows the year in which they reach age 70 and a half. For those who reach age 70 and a half after 2019, the required beginning date is April 1 of the year that follows the year in which the individual reaches age 72. If we're talking about a 401k or other type of employer plan, then it can be deferred past age 72 until retirement if available under the plan. So we don't want to assume that because someone has a 401k and is still employed by the plan sponsor, that they can defer starting RMDs past age 72. We want to check with the plan administrator, right? Because a plan could say, oh, sure, that's available under the regulations and the tax code, but we don't want to extend that. We want you to take RMDs the minute you reach age 72. And also, if you have clients who own small businesses, they would be considered 5% owners. Anyone who owns 5% or more of a business, or more than 5% of a business, is not eligible to defer RMDs past age 72. Right? So we always want to double check for that. Who does the Secure Act rule applies to? It does not apply to an IRA owner who died before 2020, and it does not apply to a beneficiary that dies before 2020. What does this mean? It means that you could still have clients who are eligible for the old stretch distribution rule if both the account owner and the beneficiary died before 2020. The Secure Act is not retroactive, so it doesn't change the distribution options that are available to those clients where you have already set up stretch distribution strategy for them. That could still be important today if a client walks into your office and say, this is my inherited account, what are my distribution options? And it ties back to that slide where I said you want to find out, when did the account owner die, right? And is this a successor beneficiary account? The fact that someone has an inherited account and is just moving it to you, that could be a transfer. And the question then becomes, when did the account owner die, and whether or not the current holder of the account is the original beneficiary or a successor beneficiary. The RMD for the year of death. One of the questions that you want to ask is the date of birth, date of death of the account owner. And let's assume that when you look at the scenario, the account owner did die on or after the required beginning date. In that case, we need to find out, did the account owner take the RMD for the year of death? Because if they didn't, then the beneficiary has to take that RMD by the end of the year. It's still calculated as if the owner lived through to the end of the year. But one of the good things that came out of the proposed RMD regulations is that understanding that sometimes when an account owner dies, There are many instances where the beneficiary does not become aware of the fact that they need to take RMDs until close to the end of the year. And so you find that a lot of beneficiaries end up owing that 50% excess accumulation penalty. But the proposed regulation says that the 50% excess accumulation penalty, or excise tax, is automatically waived if the beneficiary takes the RMD for the year of death by the beneficiary's tax filing due date plus extension. Now, let's look at a case study here, because this trips up a lot of people, right? Client walks into your office, client says, I just inherited an IRA. You find out that the IRA owner reached age 72 this year. And so the question becomes, was that IRA owner supposed to take an RMD? The answer is yes, while they were alive. But if they died before April 1 of the year following the year of death, then that RMD goes away, which means that the beneficiary doesn't have any RMD to take for the year of death. You look at this example on your slide, where we're doing a calculation for 2022, and that individual reached age 72 in 2022, but died in 2022, and their required beginning date is April 1, 2023. So because they died before the required beginning date, then the RMD for 2022 just goes away. So there's no RMD for that beneficiary to take for the year of death. The proposed regulations now, which we woke up on the morning of February 24th and found that a lot of the things that we thought we knew from the proposed regulations were not, in fact, so. So these were published on February 24th, and they're effective January 1, 2022. The language says that for 2021, the existing regulations apply with a reasonable good faith interpretation of the Secure Act. Now, one of the questions that I consistently get is, well, Denise, these are proposed regulations. Should we even be paying any attention to them? Should we be operating under these proposed regulations? And the answer is yes, because what we want to remember is that the proposed regulations are interpretation of the Secure Act that was already signed into law. So this is the IRS saying, this is what the Secure Act means. Also, the current RMD regulations, which were finalized in 2022, which were finalized in 2002, the current regulations, which were finalized in 2002, were in proposed format since from 1987 to 2002, and that's what everyone operated on. So yes, we have to operate under these proposed regulations. Now, it's possible that when they're finalized, there might be some changes. I anticipate that any such change would be minor. And the one that most people are concerned about is the annual RMD requirements for designated beneficiaries that we talked about in part one, which, as I said, I don't think that's going to change. Now, there are three classes of beneficiaries: designated beneficiaries, which is an individual or qualified see-through trust. We covered in part one. Non-designated beneficiary, which is a beneficiary that's not a designated beneficiary, such as an estate or charity, or an eligible designated beneficiary, which is the one that was introduced under the Secure Act. Now, who is an eligible designated beneficiary? We know that it includes the surviving spouse of the IRA owner, a minor child of the IRA owner who has not reached the age of 21, a beneficiary who's disabled, chronically ill, or doesn't fall under any of the above, and is not more than 10 years younger than the IRA owner. And an individual's status as an eligible designated beneficiary is determined when the IRA owner dies. So let's take a look at what some of this means. As I said before, eligible designated beneficiary status is determined at the time of death. I'm going to be looking at an example to show you what that means in a second. Who is a minor? when the Secure Act was signed into law, we weren't clear on what that meant because the definition of a minor varies among state and generally ranges from 18 to 21. So one of the question was, well, does this based on state law? What do we do? One of the good things that came out of the proposed regulations is they now have a federal definition. We're using age 21, so it doesn't matter whether the individual is age 18 or what, doesn't matter what state law says, it's strictly age 21. Now for disability, remember when individuals are eligible to take distributions from IRAs under the disability exception, which waives the 10% early distribution penalty, that definition stands here for purposes of who's disabled. Also, if someone has been determined to be disabled by the Social Security Administration, then they are considered disabled for purposes of determining if they are an eligible designated beneficiary. Now, remember when I said that the status is determined at the time of death? Let's look at this example where a 10-year-old child of the IRA owner, which is a minor, is the beneficiary. That means they're an eligible designated beneficiary, right? The child is not disabled or chronically ill. Let's assume that that child becomes disabled 5 years after the IRA owner's death. Well, that child is not an eligible designated beneficiary after age 21. Why? Because they were not disabled at the time of the IRA owner's death. So when they reach age 21, they get switched into a regular designated beneficiary and now have 10 years to distribute that IRA. A person who is chronically ill is defined under the section of the tax code that deals with long-term care insurance, and it covers things such as if someone is not able to perform at least 2 activities of daily living. If you deal with long-term care insurance, this might be familiar to you. Now, I know some of you might be saying, well, that's some kind of responsibility that we don't want to take on to determine if someone's disabled or chronically ill. Well, the good news is that that responsibility rests with a medical professional who is supposed to provide documentation that can be shared with the IRA custodian or plan administrator by October 31st of the year that follows the year of the IRA owner's death. And for purposes of being chronically ill, the documentation must include a certification by a licensed healthcare professional that the designated beneficiary is chronically ill. So I think that's a good decision, and I think you will agree we're not medical professionals, so leave that to the medical professionals. And all that you need to do as the financial advisor is to make sure that the documentation gets to the IRA custodian by the deadline. Now, here's one that threw us for a loop. When you look at most language from the IRS and the tax code, when they talk about 10 years, they look at it from a calendar year basis, right? If someone was born in 1960 and someone else was born in 1970, that's a 10-year difference. And that's what most of us have been using to determine not more than 10 years younger. But if you've done that, look at if someone was close in age like that, you might need to go back and look at your client's file and say, is this person really not more than 10 years younger? Because the proposed regulation says that we have to look at the exact date of birth for both the beneficiary and the IRA owner. Let's look at an example where Susie's date of birth is October 1, 1953. Susie's beneficiary is not more than 10 years younger if the beneficiary was born on or before October 1, 1963, right? Now, if someone's older, of course, we know that they're not younger, which means they're not more than 10 years younger as well, and they would be considered an eligible designated beneficiary. Now let's look at the distribution options for eligible designated beneficiaries, not including spouse beneficiaries. here we're looking at a non-spouse beneficiary that's not a minor child of the account owner. Another item to add to your checklist. So you are an eligible designated beneficiary. Or what is your date of birth? Because we need to know if they're a minor child, right? So for a non-spouse beneficiary that's not a minor child, if the IRA owner dies before the required beginning date, they have two options: distributions over their life expectancy, where distributions must begin by December 31st of the year following the year in which the IRA owner died, or the straight 10-year rule. You might find that some documents default to the 10-year rule or the life expectancy rule, and might even require the beneficiary to make an election. So when a client comes in to see you and you have determined that they inherited an account from someone who died before the required beginning date, part of the responsibility is to find out the distribution options that apply to that beneficiary and whether or not the beneficiary needs to make an election to choose the option that is more favorable or preferable for that beneficiary. Now, what if the account owner dies on or after the required beginning date? And again, this does not apply to Roth IRAs. Well, in that case, distributions must be taken over the longer of the remaining life expectancy of the decedent or the life expectancy of the beneficiary. And when we're talking about the life expectancy of the decedent, it's the single life expectancy because it gets switched from the table that is used for owners to the beneficiaries, right? And the account must be distributed by the end of the beneficiary's life expectancy. So you might have a scenario where you have a beneficiary, eligible designated beneficiary, and the account owner died on or after the required beginning date. And you're thinking, well, yeah, you can take distributions over your life expectancy, but that's not necessarily true, because now we need to look further to determine whether or not distributions must end at an earlier period, depending on whose life expectancy is being used. So let's look at some calculations. Here we're looking at a case study where the account owner died before the required beginning date. And we have established that there's no RMD for the year of death, right? We reviewed that earlier, so I won't waste any more time on that. But now, because death occurred before the required beginning date, we're looking at someone who inherited $250,000. It grew to $262,500. And I like to use 5% because it's low. And I know you guys make more for your clients, but conservative rate. Under the 10-year rule, the beneficiary can choose not to take distributions until the end of the 10-year period. This is usually ideal for a Roth IRA because we're looking at amounts that would be completely tax-free and penalty-free. If they choose the life expectancy distribution option, here we're looking at where the inherited IRA was, the beneficiary, I should say, the inherited IRA holder was born in 1948. And we see the annual distributions that must be taken every year. Now, of course, from a tax perspective, the question becomes, should the beneficiary take annual RMDs or more? I'm going to defer to the tax professional on that because it really comes down to the mathematics of taxes, right? Because they can always take more than the RMD, right? But nevertheless, because if they take less, then they're going to be subject to a 50% excise tax on the amount. Now, let's move on to another example where the account owner died on or after the required beginning date. Here's a caveat that was included in the proposed regulations. The proposed regulations require a full distribution by the end of the year in which the life expectancy factor would have been less than or equal to 1 if the life expectancy factor was determined using the eligible designated beneficiary's life expectancy, and the life expectancy factor is determined using the decedent's single life expectancy. Quite a mouthful, right? Let's look at an example of what that really translates to. Here, we're looking at a scenario where Jim died this year at age 75. and his beneficiary is his 80-year-old sister, Rose. Now, we know right off the bat that Rose is older, which means she's not more than 10 years younger, and that makes her an eligible designated beneficiary, right? Jim's remaining life expectancy is 14.8 years. This is determined in the year that Jim died. Rose's life expectancy is 11.2 years based on the proposed regulations. That's also determined in the year that Jim died, even though current regulation says it should be determined next year, but that's something for them to flush out. But going by the guidance in the current proposed regulations, we're looking at what is the life expectancy of each of these parties in the year of the IRA owner's death. 14.8 years for Jim, 11.2 years for Rose. And now you're saying, yay, Rose has 14.8 years to distribute the assets because she must take distributions over the longer of, right? But the proposed regulations include a twist that says it's true that Rose can take distributions over Jim's life expectancy, but the year that her life expectancy is equal to or less than 1, she has to fully distribute that account. So now, not only do we have to keep track of the decedent's life expectancy, we have to keep track of the beneficiary's life expectancy as well. And I included in your handout a calculation. As usual, the RMD for the year of death must be determined, and if it wasn't taken by the decedent, it must be taken by the beneficiary. Now, take a look at this model here, where I modeled Rose's distribution that is done over Jim's life expectancy. Remember, his life expectancy was 14.8 years, and we subtract 1 for each subsequent year. That's referred to as non-recalculation, and is always used when you're using the life expectancy of a beneficiary other than a spouse beneficiary, right? So we always subtract 1 for each year. And you'll see that in 2033, there is still 3.8 years left, right? Yet the account has to be fully distributed in 2033. Why is that? Because that is when Rose's life expectancy would have been less than or equal to 1. Quite some gymnastics there that has to be done to keep track of Rose's distribution. Now, of course, the question becomes, if you don't mind me going back a little, you'll see that the distribution in 2033 is significantly larger than other distributions. And so a planning question becomes, should Rose only take RMDs anyway, or should she take more so that at the final year, there's not that big jump in the distribution amount that she needs to take? So let's move on to the distribution options for a minor child. They too have 2 options when the account owner dies before the required beginning date: the 10-year rule or the life expectancy rule. But the difference is, where they're taking distributions over the minor's life expectancy, it gets switched to the 10-year rule when the minor reaches age 21. If death occurs on or after the required beginning date, then distributions are taken over the minor's life expectancy, but the account must be fully distributed by the end of the year in which the minor reaches age 21. But by December, let me make sure I said that right. By the end of the 10th year that follows the year in which the minor reaches age 21. I hope that's what I said, but if not, that's an opportunity to clear that up right there. So for the minor child, they take distributions over their life expectancy, and once they reach age 21, they have 10 years to fully distribute that account. I think that's clear. Now, here is a planning opportunity. What if a client comes in to see you this year and you determine that they are an eligible designated beneficiary, and you also determine that the account owner died before the required beginning date? Now, you ask for a copy of the statement and the summary of plan description, which we should always get when we're having conversations about rollovers from 401k and other employer type plans. And you realize that under the terms of the plan, your client is subject to the 10-year rule, and there's no way to get out from under that under the 401k plan. But you have determined that the life expectancy option is the better option for your client. Can you fix it? And the answer is yes. How do you fix it? You help your client set up a beneficiary IRA where they'll be allowed to take distributions over their life expectancy. You make sure that there's no limitations under that beneficiary IRA agreement. And then you move that 401k to the beneficiary IRA. Now, this is important. That movement from the 401k to the beneficiary IRA has to be done as a direct rollover where the assets are paid to the IRA custodian for the benefit of the IRA. Why is that? Because if it's paid to the beneficiary, it cannot be rolled over because non-spouse beneficiaries cannot roll over distributions that are paid to them. So check the terms of the agreement to determine what applies. Talk to the plan administrator if necessary. If you have the time, get on the telephone with the client as they talk to the plan administrator. If you can't do that, then I recommend putting the instructions in writing and tell your client, don't sign anything unless they acknowledge receipt of that letter. Because you and I know that the terminologies that we understand, taxpayers don't. And so, a taxpayer might be asking for a rollover when they need a transfer, et cetera. And terminology is very important here. So I want to make sure everything is explained to the plan administrator correctly so that they know exactly what to do. Now, that's the quick version of this. I agreed that we were going to take some more time to make sure that I go over the finer points. What are some of the things that we need to think about here? When a client comes in to see you with a beneficiary account, we want to determine if they're an eligible designated beneficiary and advise accordingly. And if they're not, then we advise accordingly and look for opportunities to override restrictions on the plan documents. And as usual, I will be sure to provide you with updates as they come about. Now, I promise you I'll take my time to make sure I understand it. And depending on the length of the document, that may take some time. I thank you for understanding that. So what's coming up next in this series, we're going to be looking at distribution options for spouse beneficiaries, including what I am calling the anti-bait and switch rule, distributions for non-designated beneficiaries, and some new automatic waiver provision for the 50% excess accumulation penalties and rollover rules for beneficiaries, spouses, non-spouses, and of course, and non-designated beneficiaries, which we know can't do any type of rollovers. So that's it. I thank you for your time. Please use the chat feature to submit your questions. You'll notice that I have an upgraded version of Zoom that provides more flexibility and privacy. Okay. Got a client who inherited a 401k and has the life expectancy option. How do I continue that in an IRA? Well, the first thing you want to do is confirm whether within the documentation that applies to the plan or by talking to the plan administrator, what distribution options apply to your client, and move those assets to a beneficiary IRA as a direct rollover. You also want to check to see if an RMD is due for the year of the rollover, because any RMDs that is due cannot be included in the rollover. That includes RMD for the year of death. That includes any RMD that your client should have taken under the life expectancy option. Because if they include any RMD in the rollover, technically the RMD would have been satisfied, but now we have an ineligible rollover of the RMD amount to the IRA. So we absolutely want to avoid that. What do you mean some beneficiaries can't do a rollover? Thank you for that question. If the only type of beneficiary that can receive a distribution to themselves and roll it over is a spouse beneficiary, For non-spouse beneficiaries that are designated beneficiaries, which are individuals and qualified trust, they can do direct rollovers from employer plans like 401ks, 403b pensions to beneficiary IRAs, right? But otherwise, there's no rollover permitted. Uh, I had a case where someone inherited assets. The estate was a beneficiary of the 401k, and somehow the 401k allowed them to transfer the assets to a beneficiary 401k under their name and social security number. That person could not roll over those assets because they were not the beneficiary at the time of death. Talk some more about when someone is not an eligible designated beneficiary because they became disabled. I'll give you an example similar to the one about the child, but in this case, assume that an individual inherited an IRA today and they're not an eligible designated beneficiary because they don't meet any of the requirements to be. But tomorrow they get in a motor vehicle accident and they become disabled. Are they an eligible designated beneficiary? No, they're not, because they were not an eligible designated beneficiary at the time of the IRA owner's death. So you're saying the stretch distribution option still applies? That is such a wonky term, which we know is just a strategy. So let me talk about whether the stretch distribution option applies. And a lot of people have a lot of different meaning for that term. If you have a client who is an eligible designated beneficiary, we know they can stretch distributions over their life expectancy. So what has changed? Well, under the old rules, if you had a designated beneficiary that could take distributions over their life expectancy, let's assume that their life expectancy was 50 years and they died later on when their remaining life expectancy was 40 years, then whoever inherited that IRA from them could continue taking that distributions over the remaining 40-year period. But that's not available anymore. If that beneficiary that we're talking about that had a life expectancy of 50 years and inherited the account before 2020, if they die in 2020, right, with a life expectancy, a remaining life expectancy of 40 years, their beneficiary doesn't get that 40-year period, they get only 10 years. So now we not only need to determine the status of the beneficiary, we need to determine if they died before 2020 and if the original beneficiary died before 2020 as well. So did the owner die before 2020? Did the beneficiary die before 2020? Because that's going to affect the successor, the distribution options that are available to the successor beneficiary. And the general rule is if an eligible designated beneficiary inherited an IRA in 2020 or after, and is taking distributions over their life expectancy and dies, then the beneficiary has 10 years to fully distribute the account, 10 years or the remaining life expectancy of the original beneficiary. And the regulations also say that for a designated beneficiary that inherited an account before 2020, if that designated beneficiary died after 2019, they are treated as an eligible designated beneficiary to determine the distribution options that are available to the successor beneficiary. What happens if someone rolls over an RMD? Well, it depends on who they are, right? I'll talk more about what the options are for a spouse beneficiary in the next session. But if that comes up, you know, I'm here for you, right? So let's talk about a non-spouse beneficiary. If a non-spouse beneficiary rolls over an amount to an IRA from a 401k that includes the RMD, first step is to determine, well, what really was the RMD? And one of the questions that I get is, well, do they take the RMD from the IRA and that clears up the issue? Really? Because when the amount left the 401k, included the RMD. Now let's assume that the RMD was 10,000. when that hit the IRA, that creates an excess contribution of $10,000 in the IRA. And that has to be corrected as a return of excess distribution by tax filing due date plus extension for the year that the rollover was done. If that's not done, it's going to be subject to a 6% excise tax for every year it stays in the account. Now, it's important that this is corrected as a return of excess and not just as a regular distribution, because for it to be considered properly corrected, it has to be done as a return of excess. Great questions, everybody. I don't see any more questions. Now, remember, you can use the chat feature to submit your questions. No one will see what you're asking except for me. A lot of you turned out today. I appreciate that so much. Thank you for your time. And I look forward to getting your questions. Enjoy the rest of your day, everybody. Thanks again.